If you have read the book Becoming Your Own Banker by R. Nelson Nash, he did not recommend that Americans use the infinite banking concept by owning a whole life insurance policy inside a corporation. The Income Tax Act in Canada and the IRS tax rules in the United States are totally different. They follow a different code. In Canada, the Income Tax Act allows a lot of great benefits for business owners who wish to put a whole life insurance policy inside their corporation rather than own it personally. The number one hidden benefit is tax. The tax rates in the Income Tax Act do favor corporations. Personal income tax rates are typically higher. The marginal rate in British Columbia for the first $500,000 of a Canadian controlled private corporation is only 11%. So if you had after expense income in your corporation of $200,000 and you're paying 11% on that, well, that's a huge benefit to use those after-tax corporate dollars to make larger premiums rather than paying 30, 40, even 53.5% on your personal marginal rate. So you get a bigger bang for your buck. Would you rather pay a premium or would you rather pay tax? And when you're paying a premium, a significant portion of that can be accumulated in the cash value of that whole life insurance policy. So rather than paying tax, you're actually recovering the cost of that tax to be able to control more of what you make. The number two hidden benefit is punitive tax rates assessed on aggregate investment income inside a corporation. Now, what does that mean? That's passive income, rents, royalties, interest. Any passive income inside a corporation is 50.7%. Once you hit more than $50,000 of aggregate investment income or passive income in your corporation, that starts eating away, eroding your small business deduction. So you want to make sure that if you're going to try and reduce that aggregate investment income or passive income, the best place to put that is in a whole life insurance policy that's owned by your company, because the earnings on that capital are considered tax exempt for as long as they stay in the policy. The third hidden benefit is the power of leverage. This point especially I want to make a big deal out of, because the power of leverage is what you do to create wealth. It's what wealthy business owners, wealthy investors, real estate investors, stock market investors, anybody that's created a lot of wealth has used leverage in order to create that wealth. Jimmy Pattison, one of the wealthiest Canadians and certainly the wealthiest person in British Columbia today, he started his empire by buying a car dealership. But he didn't use cash to buy that car dealership. He used the collateral value of his whole life insurance policy and used the living benefits of that policy to purchase the business. And that's the difference between being a saver, a debtor, and a wealth creator. Wealth creators know how to use leverage in order to earn income in more than one place. But because you have the higher contributions in the form of premiums into that policy, you have larger cash value to invest, to give to another entity, to loan to another entity, to flow up into another one of your corporations perhaps, or to pay you out a taxable dividend if you so choose. A lot of people use a whole life insurance policy that's owned by their corporation to create an ongoing income in retirement. Now, some people also use shareholder borrowing, but that's a very complicated strategy. You always need to have the proper tax advice. Hopefully that tax professional is familiar with infinite banking. And if they don't use infinite banking themselves, at least they have a practitioner who can communicate with them based on the benefits. The fourth hidden benefit of owning a whole life insurance policy in a corporation is estate planning. There's things like a credit to be able to have a capital dividend because the death benefit minus the ACB of the policy, if you're watching as a tax professional, you'll know what I mean by the ACB of the policy, will contribute to the capital dividend account. And if there's a credit in that account, then your tax professional can help you pay out a tax-free dividend to either yourself or the remaining beneficiaries after you pass away. And these are called the death benefits of the policy. Furthermore, because you've been sheltering that money inside that policy, and you don't buy a policy because you're looking for shelter. You buy a policy because you have an insurance need, and these are some of the additional benefits of that. However, if you have a tax consequence on your death, well, that insurance policy can be used to satisfy that tax debt, or at least replace the amount of money that's going to be paid out, and you can use that to replace that to your beneficiaries of your estate. And also, there are many, many different things that tax professionals can do in something called post-mortem planning. And that post-mortem planning can be enhanced with the use of a whole life insurance policy owned by your corporation. Make sure you subscribe and go check us out at IBCanada Group.com. Have a great day.